chaos begins. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, shocking news since markets plunging. And what I want you to understand is why the political elites are panicking right now, because they have made one of the biggest policy mistakes in history. And as you're about to see, this could be the very beginning of the next big bear market, as the evidence now shows that the U.S. economy is on the verge of an outright recession. Now let's head over to Bloomberg, where he picked today's story up with a headline, as Fed's Williams says now appropriate to lower interest rates. And we're seeing here from the political elites at the Federal Reserve that all of a sudden, after just a mere months ago that they were worried about rising inflation, they were concerned they were going to have to further raise the funds rate, that all of a sudden they want to lower rates, and it's an urgent move they want to make here, because in about 2 weeks the Fed's going to meet. The question is going to come up isn't that are they going to cut? The question is going to be how much they're going to cut. And Williams said there's been significant progress toward the Fed's dual goals of maintaining stable prices and maximum employment, and the risks achieving both have moved into a state of equilibrium. And that's really strange, because we have no actual evidence of what this state of equilibrium is. In fact, the Fed doesn't even know itself. I'm going to show you here in a moment in chart, but let's continue on, because with the economy now in equilibrium and inflation on a path to 2%, that again, just months ago they didn't think it was, it is now appropriate to dial down the degree of restrictiveness in the stance of policy by reducing the target range for the federal funds rate. And this has everything to do with the fact they're very afraid that the labor market is far weaker than the data actually suggests. And based on what we got today, there is conclusive evidence that it isn't. But let's take a look at this equilibrium comment, because we're looking at the consumer price index and the unemployment rate. These are the two data series the Fed focuses on, or at least wants us to believe they focus on. And here we can look back at prior times when the Fed decided it was in equilibrium and necessary to cut the funds rate. You can note that there is no consistency at all. In fact, when we look back, the Fed is either cutting in the midst of an official recession or right at the beginning. In this case, now they're looking at cutting rates as inflation remains above target, and the unemployment rate is well below where it has been in the past when they've raised rates. Putting things into question is, what does the Fed know that perhaps that we don't know? Well, I'm going to show you that evidence here in a little bit. Let's talk about the jobs market and what data came out today, as the non-farm payroll job growth comes up short, and possible warning sign for the Fed. Now, one thing we do know is that Fed Chair Powell tends to overreact. He did that by hiking rates at the most aggressive pace in history, and he's most likely going to cut rates at the most aggressive rate in history, because he doesn't want the world to know that the Fed has virtually no power over the economy. But one thing we know is not coming up short, and that is the trading accounts for our clients. Despite the fact that we're seeing the market sell off here, our subscribers are making money. Check this out. As of the close of business today, our CTA Timer Pro, now this teaches you how to trade and beat the machines. We have 4 open trades. 2 were stopped out today, that with a cumulative return of 4.85%. Now, mind you, we had a bunch of trades going into the week, and a lot of them got stopped out, and nearly every one of them for a gain. Could you imagine that? How about our Momentum Timer Pro? Maybe you like to trade the RSI, the MACD, and other technical signals. Well, we aggregate them together, give you a proprietary overlay. We have 2 open trades. Both are up again today. 1 trade closed out today for a 1.81% gain. Now, how do we have this with the edge? Well, we back tested our CTA Timer Pro, and we're beginning the process of back testing Momentum Timer Pro to give you the edge, to show you all the high probability trades. This data will be coming to subscribers very soon. You need to jump on before the price goes up. But here's what you get. You get the reports. You get every signal. I go through every one of them and tell you which ones I think you should do and which ones you shouldn't. I tell you the stop loss levels. We track all the trades and returns, the good and the bad, and once a week on Saturdays we update all the stop loss levels for you. Plus, now we have the back test and and the best part, 30-day free trial. Why no one else does that? Because they know you won't make money with their reports. Ours, 100% duplicatable. Links in the description below. Don't let this next bear market annihilate your accounts. We'll show you where to be and how to make money. Because the non-farm payrolls report rose by 142,000 last month, leaving the 3-month average at the lowest since mid-2020. Now, this seems pretty good at the forefront because, wow, that's a decent number here, which would suggest that perhaps we're not in a recession. But one of the problems with the non-farm payroll report, as we recently discussed from the expert insider that reached out to me by email, is that the data isn't accurate and it's usually revised down. And sure enough, that's exactly what happened. The unemployment rate edged down to 4.2%, the first decline in 5 months, reflecting a reversal in temporary layoffs. And here's a great thing about that piece of data too. That's right at the ceiling of where Fed Chair Powell said he wanted to see the unemployment rate. So it's entirely possible that we're seeing perhaps the soft landing being achieved here. The payroll report went up. We're seeing the unemployment rate go down, but maybe that's just not exactly the whole story. Because the labor market is clearly softening and the Fed needs to step in to cut off tail risk. The report seals a deal for a September rate cut, but the big question from this expert here is really whether the Fed goes big, because what the headline number didn't tell you is they revised down the prior month's data. And this is what we've been seeing, and what the issue we've had with the payroll reports is they're not accurate. So we get this nice looking headline number only to see it revised down. What that's caused is investors and businesses and consumers to make bad decisions. Now all of a sudden the market's starting to react and say that perhaps we're entering a recession. It's the bond market that's saying we might be already there. And hiring was weighed down by job losses in the manufacturing, retail, trade, and information sectors, as private payrolls over the last 3 months rose by 96,000 on average, marking the first time it fell below 100,000 since the onset of the pandemic. Employment growth was concentrated in leisure and hospitality, construction, and healthcare. Keep in mind that average 3-month average of data, that is data that's now been revised down to that level. Again, we see the glide path of where non-farm payrolls is going. It's telling us we're headed squarely into a recession. The participation rate, the share of population is working or looking for work, was unchanged in August at 62.7. The rate for workers aged 25 to 54, known as prime age workers, edged lower for the first time in March, maybe possibly because some of them can't find work. But when we look at the labor force participation rate, there's really one bit of information that's quite fascinating here, because we see it in blue against average hourly earnings now showing of production and non-supervisory employees. And one thing we know is that, yes, the labor force participation rate can go up right at a time around recessions, because what happens is people are losing their job and they want to enter the workforce, or they're on the sidelines saying, look, our household finances are getting worse. But look at this. You see decelerations in average hourly earnings of production and non-supervisory employees at a time when you see a peak in labor force participation. Notably, what happens, some people just give up and they stop looking for a job because there's no work. So this indication that a rise in labor force participation rate is a good sign, it's not at all. It means there's more workers now competing for fewer jobs, and that's why you see that average hourly earnings growth actually slows here, and it's validating this downward trend. Too many people, not enough jobs. But Fed officials also pay close attention to wage growth, as it can help inform expectations for consumer spending, the main engine of the economy. As average hourly earnings rose 3.8% from a year ago, as wages for production and non-supervisory employees, which covers the majority of workers, advanced at 4.1%, which is ahead of inflation. So this should be great news. In fact, the political elite should be celebrating that this may be indeed the soft landing. But this puts into question of why is the market reacting the way it is? It's because the market's starting to figure out we may not be at the beginning of a bull market, that is. we may be at the beginning of a bear market. I'll give you some more convincing evidence here in a bit. Now let's take a look at why the political elites are going to say, maybe inflation is coming back, because look at the consumer price index here shown in blue against average hourly earnings of production and non-supervisory employees, both shown on a year-over-year rate of change. And we can see very clearly right now that the red line, of course, average hourly earnings, is above the consumer price index. And this is good, because in the past, when that happens, you see a resurgence in inflation. In fact, going into recessions, we typically see the opposite effect, where we see a deceleration in earnings led by, of course, rising inflation, otherwise known as stagflation. So this is telling us that perhaps things aren't actually that bad out there. But the issue is they are, because now let's take a look at the same data that look at total compensation growth, because while employees are still getting decent year-on-year wage increases, their hours worked are not rising. We see that relationship here. You'll note that there is one that stands out. Again, we come back to total compensation growth decelerates against rising inflation. You get a recession. You get it here again in the dot-com bubble and the global financial crisis. But right now, it suggests that maybe things are okay. But remember, we talked about this in the show the other day, that Challenger Gray and Christmas said, look, there's going to be a bunch of layoffs in the IT sector coming, and we see other evidence that hours worked are slowing. We're seeing this in the survey data, where we note the manufacturing sector continuing to lay off, the services sector employment starting to stall out because backlogs are getting eaten away. There isn't a strong enough amount of new orders to sustain the workforce. So perhaps it's just the government data doing what it does, which is normally being lagged here, before it accelerates and catches up to the downside. But with the start of rate cuts this month all but guaranteed, a key question for the Fed is how large the reduction might be and what the pace and size of cuts will be thereafter. And while Williams didn't offer insight into the size of central bank's first rate reduction, he said policy officials can move toward neutral stance intended to either promote or restrict economic activity over time, depending on the evolution of the data. The reality is they don't have a clue what the neutral rate is, because remember, they told everyone they went into a restrictive space. Well, now you're seeing it, if that is correct, if you believe in the power of the Fed. Now the question is, where is the neutral rate? If you ask them, they'll tell you. They don't actually know. And Powell similarly said last month that the timing and pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risk. Well, the incoming data doesn't suggest a big rate cut. That's the problem. But the balance of risk is now skewing to the downside, which sets up the perhaps that he's going to have to do a 50 basis point cut. If the Fed does that, it's telling us that they know something is wrong with the economy that's not showing up immediately in the data, and that is a huge warning. But one thing again that's going to go in the Fed's favor for a smaller cut is this, as we see pullbacks from the Sahm recession trigger as wages unexpectedly rise. So this from Zero Hedge, and this is interesting because when we look at the real-time Sahm roll, and this is something developed by a former Fed official, and what it shows us here is when the blue line, which is the real-time Sahm roll recession indicator, crosses over that red line, well, what that means is we are in a recession. And we can look back and see this every time that happened. And right now it says we're right on the edge. So perhaps the argument is maybe payrolls are rebounding. Maybe the unemployment rate's going down. Maybe wages will stay above inflation that's going to cool off. Or maybe there's something seriously wrong, and that's why the equity market is plunging today, because it's not the only thing that's headed lower. Well, interest rates are as well. As U.S. yields sink as jobs put jumbo Fed cut in play, and this is the big one. The Fed doesn't care about inflation that much. They don't care about wage growth that much. They don't even care about the stock market that much. There's one thing they do care about, and it's what the bond market tells them. As Treasury yields dropped across the U.S. curve, with two-year yields falling 7 basis points to 3.68%, swaps traders are now pricing in a 50% chance of a half-point Fed reduction this month. As stocks fluctuated, well, that was generous because then they plunged. And here you can see why it's all about the bond market, and more importantly, why it's all about two-year treasury yields. Here you can see in red, two-year treasury yields leading the federal funds rate, in blue down, causing the Fed to cut back in the late 1980s. The Fed then reacted again in the mid-90s when we see two-year yields fall. They did it again heading into the dot-com bubble, again letting the bond market lead the path. It happened once again during the global financial crisis, happened before we went into the pandemic, and look now, two-year yields are telling the Fed you need to lower policy rates. The only question being is by how much. But what's interesting is Citibank traders think it's going to be a whole lot more. In fact, they're betting on 3 half-point Fed rate cuts this year. That's staggering, as the Fed does not take baby steps, well, at least not under Fed Chair Powell. They showed no hesitation on the way up in 2022. It won't show any on the way down either. If today's job numbers disappoint, which they did, the Fed is likely to cut 50 basis points. But get this, not just in September, but in November and December too. And if they do that, what it indicates is the U.S. economy is headed into a recession. And I'm going to give you all the evidence to convince you that perhaps we might be in the very early stages of an all-out bear market. Because when we take a look at the yield curve, and this is expressed as 10-year yields minus 2 years, shown in red, and they're inverted when 2-year yields are actually higher than 10-year, when you see the red line below that horizontal black line. And we've got that against the federal funds rate. And one thing I want you to see, as the curve steepens, and this means rates are falling, then what you'll note is the federal funds rate in blue is decreasing. You see that happen going into the 1990s recession. The Fed reacts to that. They do it again at the dot-com bubble and at the global financial crisis, and even heading into the pandemic, which likely would have been a recession otherwise. But look now, we're starting to see the curve uninvert. And mind you, this is the longest inversion in history now, and that means the Fed is going to have to cut rates, as the market tells us. But despite the fact that equity buyers believe that a Fed rate cut is bullish for stocks, the evidence is it's not at all. Because what happens when you get a steeper yield curve, many people believe, well, the banks will run out and lend, but that's not the case at all. As I'm going to show you, it leads to tighter financial conditions. Because even though the curve starts to normalize where 2-year yields are below 10-year, and we know that banks borrow at the short end of the curve and lend at the long end and make money on the spread, there's one problem. Because interest rates are falling, the spread is still very thin, the banks do not have a lot of margin for defaults, meaning they tighten financial conditions. The evidence of that is conclusive. As we look at the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes, this shown in blue band. When you note here, anytime it's above the horizontal black line, it means on net banks are tightening standards on the way up and including on the way down. They're only easing when it gets below. Against that, we see the yield curve, and what happens when the yield curve steepens, the banks still tighten. We can see that here in the early 90s. We can see that here at the dot-com bubble. It starts to uninvert, starts to steepen here. The interest rates go down. What happens? The banks tighten standards. It happened again going to the global financial crisis. It started to happen going to the pandemic. And now, as I have told you was likely to happen, we're going to see banks further tighten lending standards. It's going to restrict the creation of credit. And one of the problems is when you constrict the creation of credit in a debt-based economy, at some point you don't have enough money to pay on all the debts. But the bigger issue is you don't have enough money to support asset prices, which is why we're likely to see a commercial real estate crisis, why we're likely to see the small and mid-sized regional banks go insolvent, but more importantly, for people who are invested in the top 5 and top 7 stocks and not using our reports to find out where they should be putting their money, what it suggests is the stock market doesn't have enough money to keep its valuations up either. And here's all the evidence you need, is because when the yield curve steepens, as indicated by falling rates, it's not bearish for the stock market as investors believe. In fact, here you can see the NASDAQ 100 shown in blue. As the curve steepens, you enter a bear market. You see that happen again during the global financial crisis, and you're starting to potentially see the early signs of it now. The only time it didn't happen was heading to the pandemic, when investors didn't buy into it because Fed Chair Powell aggressively cut rates, and the pandemic saved them from the embarrassment of finding out we're in a recession. But now you know the real truth here is there's a reason the political elites are panicking. This is the beginning of what could be all-out chaos for the U.S. economy, the U.S. labor market, and the U.S. stock market. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.